Hello and welcome to episode 316 of the Money to the Masses podcast with your resident expert, as always, Damien Fay and me, Andy Leaks. Damien, welcome back. How are you doing?
Yeah, it's good to be back. A new tax year. I think we should be feeling excited about that. In fact, that is part of what we're doing today on the podcast. But it's a really busy time for us, isn't it? The tax year end. If anybody out there who listens to this podcast works in the world of finance, they will know that things come to a head around the tax year end because lots of people wanting to invest money in stocks and shares, ISAs, lots of allowances have to be used or lost. And so that's part of what we're going to be doing on this podcast this week. But that all comes to a head. So we get a lot of input and a lot of questions from people out there. So it's a busy period. We've just come out the back end of it. And now I feel like I need a break. But actually, we might as well mention that at the beginning of this podcast that next week, Andy and I will have a mini break. So there won't be a show next week, but we feel like we deserve a week off, and then we'll be back the week after. But I will more than likely do a midweek market show regardless.
That's brilliant. Well, I mean, what a segue as well. Talking break straight into the fact that we're going to have a little well-earned rest as well. Of course, it's the end of the half-term breaks and we're spending some time with our families. So while we're still here and the listeners have still got us this week, what have we got coming up on this week's pod?
One piece this week is focusing on the new tax year. So it's the new tax year, and I'm going to go through with everybody the new allowances that have been announced, because some of them have increased, many have stayed the same. So I want to go through and just give people a steer of what the different tax allowances that they can take advantage of are, so they can plan ahead this tax year and take advantage of them. But I'm also going to tell them, therefore, how they could potentially earn £78,000 a year tax-free. And so I'm going to go through that. The next piece I want to do is talking about families is quite a nice segue, is junior SIPs. We get lots of questions about junior SIPs, and it's as a result of the Millionaire podcast episode we did back in 2020. And lots of people have been in touch to ask us about junior SIPs, who does them, the rules around them. So I want to cover that off in the podcast this week. And finally, a bit of a spring clean element to this week's podcast with mortgages. I've had a question from somebody asking just a couple of tips that could help them if they're going to remortgage or take out a new mortgage in the coming months. So I've got a handful of tips for people who are looking to potentially buy a house in the coming months or, as I say, remortgage.
Okay, so let's start with the tax piece then. As you say, Damien, we've been busy looking at all the different allowances and how things reset and restart when the new tax year starts. A lot of people leave it till the last minute, don't they? It's all about squeezing it in before the end of a tax year, but we're kind of flipping it on its head.
Yeah, so let's plan ahead. That's the best thing to do, because we get to the end of the tax year and people then are thinking about their earnings and the allowances. We can do these things in advance. And actually, by going through and telling people what some of the allowances that are out there they could be taking advantage of, it may encourage them to go and look at them and actually use them this time around. And interestingly, Andy is probably bored of talking about tax allowances internally anyway in the office, because one of the jobs Andy did at the beginning of this week was go through and actually update the whole entire website of every reference of the previous tax year for the new tax year allowances, which is what inspired this piece. So Andy is probably, he's actually smirking, you can't see him, but he's sitting there probably thinking how many times he had to change 2020, 21 to 21, 22.
Yeah, what's frustrating about that is I was so in the zone of sort of thinking 21, 22 that I've started to date things when I'm writing down the date as the year 2022. I'm getting ahead of myself already. You know, when you turn over to the first day of the year and for the first few months, you keep referencing the previous year. I'm kind of doing it in reverse, and I'm doing next year before I'm in a confusing place, Damien.
Yeah, come back to us, Andy. Come back to 2021. I know none of us like the way it started, but let's stay there. So let me go through a whole bunch of allowances. And these are allowances that are nothing radical, that most people can take advantage of these, and a lot of them people won't realise exist. So first of all, let's start with income tax. Now, everybody has a tax-free allowance of £12,570. That's the allowance in the 2021 to 2022 tax year. Now, if you earn beyond that, just to round it off so people understand, if you earn between £12,571 and £50,270, then you pay 20% tax on that band. On the band that's above £50,271 to £150,000, you pay 40% tax on those earnings, and anything above £150,000, you pay 45% tax. And there is obviously a tapering of the personal allowance once you earn over 100,000. So the key point I want people to hang on to is the 12,570 tax-free income tax allowance. Now, there is also a dividend allowance, which if you go back to episode 123 of this podcast, you can find out a lot more about this dividend allowance. But quite simply, it is currently £2,000. So you can earn £2,000 worth of dividends and not have to pay income tax on them.
And that's in addition to the current 12,570, right?
Yeah, so that's in addition. So let's say you had some earnings and you had some dividends from elsewhere, so you earned income, then you could have a 12,570 plus a 2,000. You see a lot of people who maybe have their own limited companies, they may be directors, so they can pay themselves an employed wage, and then they might pay themselves some dividends from the profits of the business as well. Now, the next allowance we're going to quickly mention is the savings allowance. So everyone has a savings allowance, which is, I say everybody, it actually tapers out, but at its base level, there's a personal savings allowance of £1,000. If you are a basic rate income taxpayer, then you get the full £1,000. If you are in the 40% tax band I mentioned earlier, so you earn over £50,271, then you get half of that amount. So you only get a £500 personal savings allowance, which means if you earn interest on your savings of £500, it would be tax-free. So for most people who are in the basic rate tax band, they can earn £1,000 of interest on their savings a year and not have to pay tax on it. So you can see already that you can start to add up these allowances. So this is where I'm going to. Now, if you have a 45% tax rate on income tax, you don't get anything.
And just to clarify, for those people who have ISAs and things like that, this is savings outside of tax wrappers, right?
Yeah, so we're just talking about savings outside of wrappers. Think of your typical savings account. Now, there is an additional starting rate band of up to £5,000 that you can get. Now, if you go back to episode 226 of this podcast, we did a whole show on it, on the little known tax break that exists. So I'm not going to dwell on it, but in simple terms, if you earn, say, for example, less than the income tax band of £12,570, you can get an additional £5,000 allowance applied to any savings interest, so it will be tax-free. In total, it would mean that you add it to the other £1,000 that I talked about, you can have £6,000 of interest tax-free. But the key to this part is that 5,000 band does taper. So when you start earning over the personal allowance of 12,570, it starts to taper down. And once you get to earning £17,570, you don't have any of it. The key point here, again, there are allowances here that some people could be using. Yes, you can't earn particularly a lot of money from earned income, for example, but you might have a big pot of money from savings that you might have, particularly relevant for people who may have sold houses or businesses or maybe older that have big pots of money. Now, the next allowance I want people to think about is the marriage allowance. So that was on podcast 65 we talked about. So that can be up to £1,260. In a nutshell, what happens is if you have a spouse who doesn't use their personal allowance, you can take up to 10% of that unused allowance and bring it across and add it to your own personal income tax allowance, so pushing your band up from £12,570. So that increases it. So that means that you could get another £1,260 personal allowance. Brilliant. So that you pay less tax. Now, there's a couple other allowances that I want to mention. The capital gains tax allowance is £12,300. That is the allowance that you get if you sell something and you've made a profit on. Let's say it could be some investments and you made a capital gain. You are allowed in each year to make £12,300 worth of capital gain without being taxed. Beyond that, there are tax bands that you start being taxed at, so key rates. Now, there is also a trading allowance, and we've mentioned that on a previous podcast, where in simple terms, if you, for example, started a business, you might be, like you, Andy, writing books or something like that, and you're making a bit of money, there is a trading allowance of £1,000 that everybody gets that they can apply to those earnings so they don't have to complete tax returns and it's tax-free. Once you go beyond that £1,000, then the situation is slightly different. Go back to the previous podcast where we've explained it. But there's also another allowance that you get that's in a similar ballpark, but it's called the property allowance, and it's £1,000 again. So if you earn money from your property and it's less than £1,000, you don't have to pay tax on it. To give you a good example, there are people who rent their driveways and they might live near a station, for example. Then if that money is less than £1,000 a year, then you don't have to pay tax. That is a whole part of these allowances, and it means it makes the taxation system easier, less reporting. The other final allowance I want to mention is the rent-a-room allowance. You can earn £7,500 a year from letting out a room in your house. So if say you've got a lodger, and again, you don't have to pay tax on it. And now, if you've been listening to what I've been saying and adding those numbers up, let's say, for example, there was somebody who had a home. They maybe worked in a job that was part-time. Maybe they earned exactly the £12,570. Maybe they were a director of a business that they paid themselves that amount of money. They had dividend income coming in as well that equated to £2,000 a year, exactly the allowance. Like I said, it could have been a director paying themselves some dividends, or they could have had investments that paid dividends. They would also potentially be entitled to that full £6,000 savings allowance. So let's say they'd have to have a big pot of money, but let's say that person had inherited a large sum from their parents, for example, and it was just sitting in a bank account wondering what to do with it. They might have some investments too that they can use their CGT allowance. They might be doing a bit of eBaying on the side. They could use their trading allowance, that £1,000. They might be renting out their driveway because they live near a train station, or they might have a lodger in as well. If they did all those things, which isn't outlandish, it's unlikely, but it's not outlandish. There'll be people who could quite conceivably do that. Then they could earn £43,630 this tax year without paying a penny in tax. That's an incredible amount of money. Now, if you take into account that a lot of people will have children. Now, you get paid child benefit. It's not means tested as such. There does become a point where if you earn over £50,000, it starts to be withdrawn, but initially you receive it for having children. So you can mitigate that tapering off if you are in a household, because if you're married, for example, and one of you earns over £50,000, it starts to become tapered. You start to lose your child benefit. But let's assume that neither of you do. Then if you had two children, the child benefit rate now has gone up to £21.15 a week for the first child and £14 a week for the second child. Do the numbers, add that up. That's another £1,827. Put that together, that's £45,457. Somebody who could be, let's say, a single parent, as I described, who's inherited some money or got some investments, works part-time, has a lodger to help pay the bills and lets out their driveway, for example, and has two children, they could conceivably take home £45,457 in this tax year without paying any tax. And the reason I want to talk about in the podcast is that there are people who can arrange their finances and do to take advantage of this. And one of the things that I've learned from the time when I was in the city, when we were giving advice to very rich people, they are very astute at making sure they use all their allowances. Now, let's jump to a slightly different example. And you had a married couple or somebody in civil partnerships. Then if you do the numbers, they could earn a total of £78,067 tax-free in a given year. And that includes them receiving their child benefit because it hasn't been withdrawn. And just to quickly run through it, if they both got their income tax allowances of £12,570, they both use their dividend allowances, they use their savings allowances for the full £6,000, they both use their CGT allowances, trading allowances, they both did a bit of eBaying. Obviously, let's assume they own the property together. They're only getting the one property allowance and the rent-a-room benefit and the one set of child benefit. But because their earnings, neither of them is earning more than the threshold of over £50,000 where the child benefit starts to reduce. That means in total they would get £78,067. Now, some people might think that sounds a bit far-fetched, but it's not particularly, because if somebody owns a business and they have a limited company, they can employ themselves, they can set their wage, they can pay themselves dividends. If they happen to have large savings and investments, they could draw down from that, they could use their capital gains tax allowance. Now, on that, when I used to work in the city and we were advising very wealthy people, one thing they would do is they would invest for the purpose of using their capital gains tax allowance once they retired. They would be building up a capital gains tax pot. That pot that was invested in the same way as all their other parts of their portfolio, maybe pensions and ISAs, they had a pot that sole purpose would be ultimately to utilise their and their spouse's tax allowance every tax year so they could live tax-free. This is what rich people do. And they are astute and use their allowances by mitigating taxation. And so they would only withdraw just enough from their pensions so they weren't paying excessive amounts of tax. They wouldn't go into the higher tax brackets. They would make sure they were only withdrawing enough to maybe be basic rate taxpayers. So this is what happened. So the message of this piece is, firstly, the allowances are what I've just stated, but make sure if there's any on there that I've mentioned that you are unaware of, that you haven't used before, maybe the marriage allowance, perhaps it's the trading allowance or property allowance, then do listen to the shows that we link to in the show notes and the links that we're also going to put into the show notes for articles you can read around it. So there you go, how you can earn £78,000 a year and not pay a penny in tax.
Okay, so in the last few months, we've received more and more correspondence now, mainly on the back of that excellent podcast. I'm going to say you did, Damien. You did the research. You delivered it. I just helped to edit it together. A great piece on the Millionaire episode that probably was one of the best in terms of the feedback we received. And from that, we've written articles and we've done research and we've had lots and lots of questions about the best ways to invest for your children. One of those being junior SIPs. So you're going to cover that off in this pod.
Yeah, so if you've not listened to the Millionaire podcast, it was episode 283, and we did then release a shortened version of that podcast because the podcast 283 focused on a number of pieces. The Millionaire section was only part of it. So we did launch it and issue a separate episode that just talked about how to become a millionaire. And the crux of it is that we explained how you could invest and the amounts you could invest, which are relatively low, and how you could accrue a large sum by the time you wanted to retire. And particularly, I honed in on the idea that you can make your children millionaires by investing relatively small amounts every month if you start early and use the powers of compounding over time to be able to create a very large pot of money that was even beating inflation. So even if you adjusted for inflation, they would still be millionaires by the time they got to retirement. Now, one of the ways to do that would actually to be used junior ISAs, because then you don't pay any taxation. But of course, there are people out there who don't like the idea of their children getting hold of the money at 18, which is what happens with a junior ISA. Once you put the money in a junior ISA, it will become theirs once they hit the age of 18. And unless you teach them about the values of money and what they're trying to do and why they should keep investing, then perhaps some people are worried that they wouldn't continue the journey. Of course, the other option is to use a junior SIP. And a junior SIP is basically a self-invested personal pension for children, as the name would suggest. And there's been a lot of discussion in our Facebook group. So if you're not a member of the group, go and find it, facebook.com/groups/money to the masses. We've just hit over 3,000 people in that group, which is a fantastic achievement. So thank you to everybody who is part of that group and keeps it the friendly community that it is, and very welcoming, and the knowledge that people share and the questions they ask. And one of the things that's popped up a number of times is junior SIPs, people trying to understand them. And I've had a number of questions from people asking me about junior SIPs. So I'm going to run through it today about junior SIPs and mention one or two out there that may be worth looking at. So a junior SIP, as I say, is a self-invested personal pension for children. And essentially, it's a bit of a marketing angle because there are providers out there, so insurance companies, for example, who provide pensions who would allow children to open them. So they can be opened for children. Children can't do it themselves. An adult has to do that. The guardian or parent has to do it, but they can be opened for children. And again, it's quite a nice circular link. But going back to my days in the city, we used to have people who earned £1.5 million a year who were maxing out their contributions to their children's SIPs year on year, because they were essentially trying to build a pot for them, but also just trying to get a bit of tax back from the government, essentially, because they were high rate taxpayers. So there you go, another example how wealthy people will use anything in their powers to reduce their tax liability or try and get something back from the system, something that's essentially fair and legal. But the idea of a junior SIP, so there are people out there, companies who will come onto, who market Junior SIP. So they have a product that you can go and find. It's a pension for children. A lot of other insurers have them, like I say, but you will have to go and dig deep in their T's and C's to find out if you can open them for children. And actually, if you contact them, which we did, funnily enough, for a piece we did on the website, which we'll link to, and a lot of the providers and the people you get through and speak to don't really know the nuances and T's and C's of their own products anyway. So I think this is how the Junior SIP concept really came to the fore. I think a lot of people wanted them. So the likes of Hargreaves Lansdown, for example, started marketing them. So a Junior SIP can be set up by a parent or a guardian, and they manage this pension for the child until they turn 18. Now, if they're over the age of 16, you might have to get their signed consent to be able to take out or open the pension on their behalf. And it is very simple. It works in exactly the same way as a normal SIP. Now, if you get it with one of the big major platforms, it won't seem any different really to the way it functions to your own SIP. To all intents and purposes, it will seem the same. Now, there is an annual contribution limit they will apply to these, which will be £3,600. Now, even though children don't earn any money, if you recall from past episodes, I've explained that you still get basic rate tax relief. If you put in £2,880 into the SIP, they will still get 20% tax relief, even if they're non-earners, to top it up to £3,600. So it's free money. It literally is free money if you put the money into a junior SIP. Now, of course, it's a pension, which means that they can't get access to it to the age of 55. And there, as you know, are proposals to move the pension age for even personal pensions up to 57 from April 2028. Now, that will mean the money's locked away for a long time. So you've got to be comfortable with that. But for some people, that is an attraction. The positive, anyone can contribute to it. So once it's set up, people can contribute to it, grandparents, whoever. So that, for some people, is a real positive. You can start building a nest egg. Now, let's jump on to who provides them. There aren't many companies that market junior SIPs as an entity of their own. Like I say, there are companies that might allow you to take out a pension for their children, but if you go on their website, you won't find any link to it, and it's a bit convoluted to try and do it. So if you look at the main players out there that do, Hargreaves Lansdown does, for example, AJ Bell does, and Fidelity. Now, go and look at each of those if you want to. We've got an article we will link to on the best junior SIPs that exist, that you can go and have a look at all of those. Now, I know Vanguard are incredibly popular with a lot of the audience, but they don't yet do one. What is interesting, I don't often mention individual products, but at the moment in time, as I make this podcast, it's worth going to look at Fidelity, because Fidelity are currently doing junior SIPs with no platform fees at all. So to all intents and purposes, it is free, but the only fees you will end up paying are the underlying funds that you buy. So even if Vanguard did do a junior SIP, in theory, Fidelity's would be cheaper because you can still buy the same Vanguard funds, but through Fidelity without having to pay the annual platform fee. Remember, the platform fee is what every platform will tend to charge. Some of them are percentages, some of them are monetary amounts. So that's why we do the comparison tables on the website. So for anybody out there, Fidelity is something to look at. And of course, junior SIPs do benefit from the same FSCS protections as normal SIPs, so they're covered up to £85,000. But one quick thing I want to throw out there is that if you took out a normal pension for a child from an insurance company, then technically, if it's an insured pension, that FSCS limit has no upper limit. It's a quirk of the system, something to bear in mind. But for a lot of people, they probably won't get their SIP to be above £85,000 at any time soon. But do read the rules around the financial services compensation scheme, because it's important about where the money is invested, because when you take out the SIP, the money is then invested in underlying funds, and that's where the protection comes into its own, more so than the wrapper itself, in my view. Of course, who are they good for? I mean, people uncomfortable with junior ISAs that give access to the money to the child at 18, people who want to educate their children about investing over the longer term, or just want to get them into pensions early. And I suppose it has a benefit for anybody who wants to pass on a gift, essentially, to a child to reduce their own estate for inheritance tax purposes, because once it's set up, they could start pumping money into this SIP on a regular basis if they wanted to, which obviously for them can have some inheritance tax benefits in the long run. Of course, there are alternatives, like I say, junior ISAs if you don't like the idea of a SIP, national savings and investments, premium bonds, and of course you've got the bog standard savings accounts for children. So again, we're going to put an article on the website with links through to all those things.
Again, so moving on to the final piece of the podcast, we're going to be talking about remortgaging. Someone got in touch with you, Damien. They're about to do it soon and they're looking for a few tips. What can they do leading up to this to get the best deal?
Right, so this is a kind of a spring cleaner. It's not an exhaustive list, and the reason I think it's relevant is because I've had to do this in a not too distant past, and it's a couple of tips that, firstly, if you go back to episode 265, so I'm giving people a lot of homework this week, which will make up for the fact that we're not around next week. They've got plenty to listen to. I'm going to check next week. They've all done their homework, where we actually spoke to a mortgage broker and did a lot about mortgages during the pandemic. It's still relevant, but we talked about in that episode things that people can do for if they want to take out a mortgage. So the first thing I would do is check your credit report. So go online to somebody like Credit Karma and have a look at your credit report and see if everything that's listed on there, when you register with them, it's free. You go on there and they will give you your credit report as per TransUnion. Now, there are a number of agencies in the UK, so credit rating agencies. There's three main ones: TransUnion, Equifax and Experian. So if you use Credit Karma, that's linked to TransUnion. But you really want to check all of them because they can sometimes contain different information. So let's say, for example, you check your credit report, you've got to check that all the details are correct in terms of past addresses, anybody you're financially associated with, any credit you've got out, the balances. That's where you may end up discovering fraud in your name, which has happened to plenty of people. Somebody's taken out credit in their name and they weren't even aware, as happened to me, as anybody who's listened to the old episodes. So first of all, make sure you check that. They have some good tips in there, particularly Credit Karma do on their dashboards of how you can improve your credit score. Now, obviously, one of them is make sure you're on the electoral roll. But what I wanted to focus on is more just the sort of tidying up stuff of your own finances. That are some quick tips. So if you think about your own finances going forward and you're thinking you're going to do something in terms of mortgage in the next couple of months, then often they'll ask maybe for 3 months worth of statements for your account. They all vary. It's all different. So there's no hard and fast rule to any of this. But start to live a bit of a squeaky clean lifestyle. Stop gambling. So if you have gambling accounts in your name, then you want to get rid of them, because let's be honest, if you were going to lend somebody money and you knew that they were a compulsive gambler, would you do it? If your mate said, like, Damien, can you lend me 20 quid? And you know they're probably just about to go down the bookies anyway, do you think you're going to see it back? It works the same way in the mortgage world. They start to look at patterns. So don't gamble. Close any gambling accounts. The biggest thing I think you can do that will have an impact is go and do a direct debit overhaul. So we talked about it, I think it was the beginning of the year. I did a piece on direct debits and looking through and spring cleaning them. That is probably one of the big ones that I've done when it's come to thinking about mortgaging, because you look down at the things that you're paying for on a regular basis, subscriptions, get rid of them. Because don't forget that the lender's going to look at your disposable income. They're going to look at the commitments that you have. Reduce them as much as you can. So I've gone down and I've reduced subscriptions to services that I don't necessarily need, whether it's something like a TV service, a particular insurance I don't need, or whether it's a gym membership. All these things stack up and they will be taken into account in terms of affordability, or at least they can be. So don't give them the chance to sit there and look at it and say, yeah, but you spend X amount on all these things a month. So one of the big ones that I would do is look at every direct debit. Can I reduce it or can I get rid of it? Do I really need it? Now, beyond that, don't use things like buy now, pay later. Tempting, I know, don't use it. Try and avoid PayPal transactions to a certain extent, because I think there's an element of money laundering that goes on with their money laundering checks I'm talking about from the lenders. They're trying to work out what the different transactions are for. So don't forget, some services, even gambling services, allow you to use PayPal. So they're trying to check what's going on. That makes it difficult. So they ask more questions. I think what you're trying to do is just get through the underwriting process with the minimal fuss. Some of the stuff can be explained if you use a broker, a good mortgage broker, a mortgage advisor who can liaise with the lender to try and get you a mortgage. That's why I always favour using a mortgage advisor. I think it's about 75% of people do, and it's because they know what you're likely or more likely to get and who you're going to be accepted by looking at your circumstances. The other thing is probably try and avoid huge cash payments, so withdrawing big lump sums from your account. I know people try and do that to maybe mask a few things that they're doing, nothing illegal necessarily, but perhaps some bills they want to pay. They might just start asking questions about what that is, so it isn't a way to get round any of that. So I think that is a broad, very quick list of the things to do. And like I say, when I did it myself, I went through and thought, how can I minimize any spending? So let's stop eating out. Let's stop spending excessively on certain things. Let's cut it back. Let's start to cut back what we spend on direct debits to particular services. Do we use the gym? No, we don't. Do you know what? You can stop using the gym, and if you really want to go back, there is nothing stopping you once you get your mortgage going back and doing all these things after you've acquired your mortgage. That's perfectly fair because there's nothing in the contracts that will say that you can't go to the gym. And they might not want you taking out lots of debt, but there's nothing to say you can't go back to the gym. So for a few months of getting everybody on board with living in a way that perhaps cuts back a few bills until you get that mortgage that you want, till you've gone through it, then I think that's about the best idea. And checking all your direct debits and standing orders.
Also, I think we mentioned it on the podcast before, some horror stories. This is a very small, minor point, but for those who think it's funny to transfer money to their friends for money that they owe them and put something funny in the subject line, there have been horror stories in the past where that's actually scuppered mortgage applications. So any references to sex or drugs or things like that are probably going to cause issues. So don't think it's funny to do that to your friends, or don't make sure they don't do it to you.
Yeah, and generally the other thing is kind of again a nice circular link back to the piece we did earlier. So I explained in a piece of how you can live effectively tax-free. And this is almost counter to the mortgage piece we're doing now. There is essentially a decision that people have to make that if they want to pay less tax, it does have a significant impact on their chances of getting a mortgage. Because when a mortgage lender looks at your earnings, it will look at your taxable earnings, for example, that you get from employment, and it will use multiples of that. It's not going to use necessarily multiples of your eBaying, that's using your trading allowance or your rent-a-room allowance. They're looking at things that are sustainable income streams over time. And if you are a director of a business and you pay yourself a very small wage to keep it within the personal allowance, and you obviously can earn dividends, they're going to look at that, and it's going to impact your ability to borrow certain amounts of money because your dividends can only be paid out of profits. And so therefore it starts to look at the profitability of your business. So the key thing is, if you are thinking as well to move house or do anything within the next 6 months to a year, get your ducks in a line, as they say, but speak to a mortgage broker early. If you give them the details that you've got and say, this is how my money is earned, this is how it stacks up, then what will happen is they will be quite frank and say, look, because of the way your finances are, you won't be able to borrow much money, even though you earn a lot of money tax-free. But from the lender's perspective, they don't really take those things into account. Then you can rejig your finances so you actually probably are paying a bit more tax, but it will maximise your chances of getting a mortgage. So do speak to a mortgage broker is the message. But as a general rule of thumb, it's a choice often between tax and how much you want to borrow.
Okay, so we're done. If you want to get in touch with Damien, you can do so. It's Damien at moneytothemasses.com. If you want to get in touch with me, you can. It's Andy at moneytothemasses.com. Don't forget, we are away for a week, so we won't have a Sunday podcast out. But of course, you can always go to the Money to the Masses group to speak to like-minded people and have questions answered in there. That's facebook.com/groups/Money to the Masses. It would be amazing while we're away if a few of you could go on and give us a fantastic review on iTunes or the relevant place where you listen to your podcast. Again, it always helps us to spread the word.
Can I just say, Andy, a few of you? How about all of you? Let's be bold.
Yeah.
Let's be bold, all of you.
I was thinking that we're going to end up having to read these ones out, but that's okay. I tell you what,
I've got a pile of mugs that I haven't given away for a long time, so they're definitely is a mug-winning opportunity here.
Yeah, I agree. And if I have to spend all episode reading out thank yous and reviews, then so be it. It's a cross we'll have to bear if we get millions of reviews. So that's it. We're done.
Yeah, we're done. And so I will miss your smiling face for the next week, Andy. But until next time.
Until next time.